Dividend payments are never a guarantee. It's a fact that investors need to consider when selecting income stocks for their portfolios. It's important to evaluate a company's fundamentals and the safety of that payout before relying on it. Today, I'm going to talk about a high yielding stock that was paying as much as 7% earlier in the year. Unfortunately, it recently slashed its dividend dramatically by a whopping 40%. It nearly cut in half the monthly dividend it was previously paying to its shareholders. The stock I'm talking about is Northland Power. Its ticker symbol on the TSX is NPI. On November 12th, when the company reported its third quarter earnings, it announced that it would also be reducing its dividend. The new dividend will be 72 cents per share on an annual basis. That's down from $1.20 per share that it was paying annually. Northland makes payments on a monthly basis, and that's one of the big reasons investors have owned the stock, not only for its high yield, but because it pays in monthly installments. However, with a massive 40% cut, it suddenly doesn't look so attractive anymore. Plus, it has probably frustrated investors. Unsurprisingly, the stock fell off a cliff when the news came out. Northland Power's stock was up over 40% heading into November, but now it has given back those gains and then some. Now it's down around 1% for the year. It's a sharp turnaround for a stock that just a few weeks ago may have looked like a solid buy. Not only was it surging in value, but it offered a high dividend as well. With the stock price crashing to less than $18, that means it's now yielding around 4% with the reduced dividend. That's still an above average payout, and it's better than the S&P 500 average of just 1.2%. But it's of little comfort to investors who came to rely on that dividend income or who bought this year and were sitting on some strong gains. Now the stock has plummeted so low that it's trading around its 10-year low. This is the big problem with dividend stocks, particularly high-yielding ones. When the dividend is cut or suspended, investors dump it in a hurry because the dividend was likely a key reason they invested in it in the first place. Without it, they may want to pull out their money and go into a different dividend stock altogether. After all, a company cuts its dividend because it's struggling or facing some sort of adversity, and that raises many red flags for investors. The big question you may be wondering is, could this have been predicted? Not every stock that has a high yield is unsafe, and not every stock that pays a low yield is safe. It depends on the strength of the company's financials. There are a couple ways you can assess the safety of a dividend. One is by the payout ratio. This looks at how much a company is paying out with respect to earnings. Northland's annual dividend was $1.20 before the cut. That means on a quarterly basis, it would need to be generating at least 30 cents in earnings per share, at least. That would simply put it at 100%. Ideally, you'd want to see a safe buffer. A safe payout ratio might be less than 80%. Anything above that, and you'll probably want to dig a bit deeper to see if the dividend is really safe. In Q2, the period before this past one, Northland posted a net loss of more than $53 million. But there was a lot of noise on its financials, including fair value changes and FX. Its adjusted EBITDA was positive, but still, a loss isn't a good sign. What about the period before that? Northland was profitable, but its EPS was really light at 25 cents, which was down from 29 cents in the same period last year. Remember, it needs to be generating 30 cents at least just to get to a 100% payout ratio. It wasn't even there a year ago. So there should have been some flags just by looking at this. However, EPS isn't always a great indicator here because some companies incur high amortization and depreciation expenses, so accounting income isn't always the most reliable way to evaluate a dividend. If you focus solely on payout ratio, you wouldn't bother with Enbridge, which is one of the best and safest dividend stocks on the entire TSX. So payout ratio can help, but a high ratio isn't a guarantee that a dividend cut is coming. What can be more reliable is free cash flow. This is what cash a company generates from its day-to-day operations after accounting for capital expenditures. This is what it would theoretically have available to pay dividends and possibly put towards acquisitions, investments, or simply add to its cash balance at the end of a period. If you look at Northland's free cash flow, it has a different way of calculating it that factors in debt repayments and other items. That's a worrisome sign as well, how much it's paying on debt. And here, if you look at its financials from June, you do see a problem. Free cash flow was $58 million, but its cash dividends paid during the quarter were more than $78 million. You might, however, look at the 6-month trend and see that free cash flow was $215 million and thus higher than cash dividends paid of $129 million. And you might be tempted to conclude it's still safe, that perhaps this past quarter was an anomaly. But there's still at least some cause for concern. When the company posted its Q3 numbers, it was confirmed. Free cash of just under $45 million, which was even less than the previous period. Unfortunately, by now, it's too late. News of the dividend cut has already come out. The company has been building large offshore wind projects, the Baltic Power Project and the Hai Long Project in Taiwan, which are expensive investments and thus require a lot of cash. When factoring in this expansion and the shaky financials of late, it definitely suggests there was some elevated risk with the dividend going into its Q3 earnings. But I'm not going to say you should have known a cut was definitely going to happen. However, there were definitely risks with the stock. Management admitted that the growth was a key reason for the dividend cut, saying the move was to provide greater financial flexibility for self-funded growth while maintaining an investment-grade balance sheet. Hindsight is always 2020, but there were definitely some hints the dividend wasn't safe. The reality is that this is a cash-intensive business. And for a company growing its operations, it can be challenging to balance both growth and a dividend, especially when the yield is high. For management, it may have thought it was justifiable to cut the dividend, knowing that the stock would still be yielding a high amount after the cut. Prior to the dividend cut, Northland's yield was up around 5%, and that's with its share price surging this year. Earlier in the year, it was as high as 7%. Management may have already been contemplating a cut by then. Is it worth taking a contrarian position in Northland Power right now? The stock has taken a beating, and it's now back to around where it started the year at, near its 10-year low. In these situations, I don't think it's worth investing in the stock just because after a dividend cut, investors lose trust in the stock and it can be a while before it ends up recovering. Don't expect that Northland's power stock has bottomed out as it could still end up going lower. It may be worth watching and tracking the stock to see how it does, but I suggest waiting at least a few quarters to see if its cash flow is improving and that the business is going in the right direction. But there's definitely no need to rush to buy it right now. What do you think about Northland Power and the news of its cut? Let me know in the comments and if you're buying it or any other dividend stocks. If you made it this far, please leave a like and be sure to subscribe for more of these types of videos. Thanks so much for watching.